Welcome and thank you all for joining us today. It seems like a very quick turnaround since our last one, because I got out of sync for a week there. So it is a little bit quicker turnaround, but thank you all for joining us again today. Today we've got the great pleasure of having James join us from our Sydney office. So welcome, James, and thanks for joining us today. I know you had so much choice in it. So before we get stuck into today's topic, I don't really have a lot in the general space. I will say that we're continuing to see an upward trend in corporate insolvencies. So they were up again about 15% last month, month on month. So we are still continuing to see that increase of corporate insolvency, not necessarily from the courts though. The courts aren't necessarily driving that activity. I think a lot of people are realising, on top of the recession that we're not having and the interest rate rises and inflation, I think a lot of businesses are just hitting the wall a little bit faster than they would like. But interestingly, at the moment, corporate insolvency, personal insolvency is down a little bit, probably down by about 35% on pre-COVID times. Slowly rising, but not to the same extent corporate is. And I anticipate that we will see a much greater increase in that over time. But having said that, the pressure on mortgages and the fact that there is some equity in there, we're also hearing and seeing that some people are starting to sell up, and that's an opportunity for the ATO to get paid out on the back of director penalty notices, which is a real shame, but that's the way the system works. So it's just something to keep in mind. So we'll get stuck into today's topic, James, but just before we get into the nitty gritty of it, as I mentioned, you're up in our Sydney office, but you actually joined us about 4 years down here in sunny Melbourne, and spent a couple of years working with me down here in the Melbourne office before you went up to Sydney. So why don't I give you the floor a little bit, just to give a bit of a history on who you are and where you fit in.
No worries, Ashley. Thanks for that, and welcome everyone to today's webinar. So, yes, I've been with Jonge for the past 4 years there under Ashley for some time, and then about 18 months ago, I decided to take up the opportunity to relocate back up here to sunny Sydney, which is fantastic, as I'm originally from up this way. I grew up in Bowral on the Southern Highlands, so it's fantastic to get back up here again and lead the Sydney office. But in terms of my background, before Jonge, I've been in finance for about 15 and a half years, but and also I got a background in intellectual property law as well, as a practitioner and as a trans-Tasman IP attorney as well, which adds a lot of value to our clients, especially in today's day and age, with intellectual property being quite a big asset of a company, and comes into play as well too from a risk perspective sometimes when we're undertaking insolvencies and restructures.
Yeah, cool. Oh, certainly a wealth of knowledge from, and again, a different front. You know, I think over the last couple of months we've had ex-IPs and credit bankers, and coming from the finance side just gives the whole strategist team Australia-wide a really good spread of knowledge that we share regularly with each other to help get the best results. So if we get stuck into today's topic, James, when we talked about what we wanted to cover, you sort of wanted to have a bit more of a focus more on just what actually happens on the from the balance sheet, because we're seeing a lot of people who are going straight to an IP, and then all of a sudden they're finding all these problems that they didn't realise were there. So what we thought we'd do is have a little bit of a tour through the balance sheet on some key items, so that the people listening today, the advisors today, can be a little bit aware of some of the issues that when they're talking with their clients, it may be that you do need to get that specialist independent advice rather than going straight to an IP with some of these issues. So that's where I think we'll start, rather than going straight to the IP, James.
Excellent. Thanks for that, Ashley. And as you said, it is really important to get independent advice before going straight to an insolvency practitioner, because sometimes you can have a look at the balance sheet and there'll be a number of red flags, which I thought would be important to talk about today, which some of our viewers might not be aware of when an insolvency situation occurs. Because sometimes, these things can be handled and managed if you have the time. But then again, when the pressure's on, if the company's facing a winding up application or another demand for the courts via creditors, then, time is of an essence, and it's very hard to get these things dealt with and rectified to, really help your client situation. They can, have an ongoing snowball effect down the track.
Yeah, exactly. And I guess one of the key points is that, once an insolvency practitioner is appointed, and we're not IP bashing here, it's just it's the way that the rules and the law work, is that whether it be a VA or a liquidation or even in a personal insolvency, once they're appointed, what's going on in the business is locked and frozen, I guess, for want of a better way of putting it. And your ability to make changes or to make adjustments to that prior, once they're appointed, basically doesn't exist. So there's a number of items that we wanted to go through today. And so why don't we start with the big one, and that's director loans. So director loans can obviously be an asset of the business, or they can be a liability of the business. And the impact and effect of those is obviously very different. So why don't we start with the asset side today?
Certainly, Ashley. And as you were saying, it's not about IP bashing, because insolvency practitioners play a really important part in terms of a liquidation to act on behalf of creditors. And when it comes to the balance sheet, one of these things that the liquidator is going to be looking for and acting on when they appear is Division 7A loans. And that can become a real big issue in terms of an insolvency situation. Now, if we look at a liquidation, a liquidator's role to start with, among other things, is collect things such as Division 7A loans and any other assets for the benefit of creditors. And with these Director 7A loans, one of those assets that a liquidator need to pursue to get a result, especially if people are owed money at the end of the day, whether it be unsecured creditors, the ATO, and priority creditors such as employees. Now, one of the problems that arises for directors as well too, the liquidator will then, issue a demand and try and get the liquidator to pay up with Division 7A loans, which they have a right to do. A lot of directors won't know what that demand's for, because, as we'll talk about later, they think these Division 7A loans are for other things. Now, when a director has such things as a Division 7A loan, this can be a problem, especially where they have assets at risk, where it can lead to things such as personal bankruptcy down the track, because the liquidators can pursue a director for any other assets that they might have behind the scenes in their personal capacity.
Yeah, so I'm sure you've heard it as often as I do, but when we sit down and do a review with someone, and we look at the balance sheet and we go, oh, look, you've got this loan here where you owe the company money. They're sort of, it's almost like it's the first time they've seen it's there. And they didn't even know that the loan was there in the first place, because unfortunately, a lot of business owners don't look at the balance sheet very often.
Exactly, and all the time, Ashley, and you're certainly right with that. And it's a genuine mistake that directors walk into and just don't understand, because at the end of the day, they think these Division 7A loans are just part of their wages, because it hasn't been properly explained to them what the consequences are of drawing cash out of the business. And they might do it for wages, and they might do it for other purposes as well too, to cover other different expenses. And the problem is that they just don't understand that if a company goes into liquidation and that loan is sitting there, that's when it's going to have those consequences in insolvency. So one of the whole reasons, but to be fair, most of the time that they don't know why it's there, they just need to take into account and have a proper understanding with their account of what it actually is and what these consequences are of withdrawing cash from the business.
Yeah, and look, we've I've spoken about it before on other webinars about, it is actually a flag where they're pulling money out. Some of them will have a wage account, and they will take a wage every week in the normal payroll. But when they need some extra cash to deal with something personally, they'll just take that out, and it might get coded off to the balance sheet. And of course, a lot of these things aren't recognised till the end of the year. But you mentioned a couple of times there that the liquidator has an ability to go after the personal assets, and again, it's something that I think some directors don't fully understand, that they think because they're in a company, their personal assets are protected. But can I just get you to talk a little bit more about why that's such a, and what assets a director has is why it's so important as part of the plan?
Yeah, exactly. And with that, in terms of talking about the personal assets, like a director might have external shares that they might have in a ComSec account or something like that. They might have equity in real estate. They might have other unencumbered vehicles or anything else that was considered, real property that a liquidator could put into cash quite readily for a bankruptcy scenario. And the problem with that, if they've got those assets at risk, well, mate, they're going to lose them.
They don't have to lose them, so that's why. But I
They
guess
don't have to lose them
point,
if they don't take the right steps. Sorry,
so the point, I guess, is well, the big thing is that it's really a director's loan is like any other creditor. If we any other debt that needs to be collected, the liquidator, if there is something that's behind the so if I'm chasing another client of mine, if I know that they got plenty of cash in the bank, I'm going to pursue them harder than if I know that they're broke. So a liquidator who knows that there is a property behind there, the ComSec account and things like you talked about, they're more likely to go harder at the director to get their money back for the benefit of the creditors.
Exactly.
So that's really why personal assets become a real critical part about it. So because we see a lot of the time that directors don't get the really don't understand the full flow-on effect of them personally, because they think it's all happening within the company. So they don't fully grasp, I guess, why they're being affected when this thing comes up, are they?
No, they're not. And the thing is, they think that it is, as we've talked about earlier, they do think it's part of their wages, but then because they haven't converted it from a director's loan into actual wages, it's still sitting on the balance sheet, and that's why it's at risk.
Yeah, okay, and that's again, we talk all the time about the holistic approach that we take, is that if we are looking to recommend a liquidation or a VA or whatever we're doing, we're always looking at that next step at the personal level so that we can have the holistic approach. And I think for those who were with us last month, we talked about, planning for claims to come, knowing that we've got the personal side of things protected. So let's just stay a little bit focused on the loan account stuff for a minute, because if we open the door to all of the tentacles that can come out of the personal attacks that can happen, we can end up in a very different rabbit hole. So in a liquidation scenario, you open the door to personal debt collection on the director. Is the impact any different if we go down the voluntary administration path?
Well, yes, actually, it certainly is a lot different because there's two sides of the story, and there's a bit of an answer to that is yes and no. So, as you know, when an administrator is appointed to one of these main functions, it's to provide a report to creditors setting out what the assets of the business are and what their likely recoverability is, and if a docker is, proposed, what that likely return is going to be, either better via liquidation or under the docker under the deed of company arrangement offer. Now, the issue in administration is twofold. So firstly, if there is a director loan, it is potentially collectible asset in liquidation. So if the company goes into liquidation, then obviously they're going to go down the path of having those demands against the liquidator, but also incurring
against the director. Yeah,
exactly, to do that. So this means that any docker offer, needs to be addressed to cover this amount. Otherwise, a liquidation scenario could be a better option at the end of the day, rather than accepting a deed of company arrangement, especially if the return is going to be better to creditors. And let me try and explain that further. So let's say if there's a director's loan for $200,000, and for its simplicity, is the only asset of the business, in the VA report.
That'd be nice.
Exactly. It would be nice, wouldn't it? And in the VA report, again, for the simplicity of administration, would have to say that if you put the company into liquidation, they could recover, the $200,000 there. So this means that if a director wanted to put up a DOCA, the offer would need to be, significantly higher than the $200,000 that the creditors receive in the liquidation for it to be, appear to be a fair offer. Because at the end of the day, it's going to be a choice to liquidate what's going to be the easier path.
And there would have to be the simplest DOCA in the world if it was just the one number on one side and an offer on the other. But I guess really what you're trying to say in simple terms is that an asset director loan will effectively increase the value of any DOCA that we need to propose on the benefit to get it through.
Exactly. And the scenario that we presented there is really in the simplistic world, because we know from recent experience on the last administrations that we've tended to, we've really had to work back through the figures and technically do an audit of the financials to come up with a significant better offer for creditors than what would otherwise be there.
Yeah, so, and again, I guess really in either way, the key message that we're trying to put out across to everyone today is really quite simple, is that if you're looking to put a company into administration, having the review of the balance sheet first is a critical thing that needs to happen before appointment. So James, we're often with the loans, you mentioned a couple of times there that, and I know from experience in talking to people that they think it's just their wages. And sometimes it's a legitimate way of the director draws money out, and then at the end of each quarter or at the end of the year, then the accounting entries are done to turn that into wages, and it's turned into either a group certificate summary, or it's taken as a director wage and put through the system and sent to the director personally. Some of it might stay as a Division 7A loan. So what are the impacts if we try and that's all fine if you're not in insolvency, but once that point in time where we have to freeze things occurs, that's when this becomes a problem. So what is what are the impacts if we're trying to consider this to be a wage?
Thanks, Ashley. Yeah, there's certainly going to be a number of impacts there for directors in this situation, an insolvency event. So because when it comes to the actual point of the liquidator, the one thing that they're going to ask for the tax returns to confirm if they're wages. Now, if they haven't put in their tax return, it's still there sitting there as Division 7A loan for the collectability. Now, the next other problem that they'll have there is that, if it can be confirmed whether the tax return, if it can be confirmed through tax returns whether it is an intent or not, to convert it into wages, is it going to be accepted?
Yep.
That's the other point of view. Now, the other problem is that if, it converts into wages, has the director really and the accountant can, take into account what the actual personal taxation issue is going to be at the end of the day? Because we see a lot of these director loans and Division 7A loans, they're not small amounts. They're usually sitting in the quantum of anywhere from, $200,000 or $300,000 at the time. And when you're paying tax at that higher rate, especially if it's gained in 1 year, that's going to be a significant tax liability on the other side they'll have to pay.
Yeah. All right. Well, okay. So that's asset loans. That's the asset director loan. But the other thing, and again, we're seeing this in the last couple of years, big time, is that directors are actually putting a lot of money into their business. So you can end up with liability asset loans. So let's jump onto that side, and what are the impacts of that?
Thanks, Ashley. That's a really important one to highlight as directors putting money into the business. And we see this all the time, especially when you're looking at businesses such as franchises. They're a significant one that we do see there a lot, where people have purchased a franchise, they've put the money into the company and then purchased the franchise from the franchisor. Now, one of the first things with first, I guess, big one, so a director loan is effectively just another unsecured loan in a liquidation or a VA scenario, that the director has the same position as all other creditors. as an unsecured credit. Those, of course, if they haven't secured their loan, though. But that we'll come back to that and talk about that later. I have to say, though, when we find this on the balance sheet, one of the first questions is always, can I get that back? Is that the question that directors ask us there? And it's like, well, mate, if your loan's unsecured, it's not quite the case.
No, yeah, it's certainly something I've heard over the last 15 years is, oh, well, I put that money in, surely I can get it back first. But in some ways they actually rank lower, don't they?
Exactly. So true. Yeah.
So you mentioned a couple of times, well, you mentioned about whether it was secured or not. You said you wanted to come back about that. So why don't I let you just have a chat about security?
No worries. Okay. So talk about the security side now. This is really important to get it done from the day dot when this money is coming across into the business, because there's certain rules around the Personal Property Securities Act that need to be followed when registering a security against a company. Now, one of the things is to have drawn up by a legal practitioner is a proper loan agreement. And this is not something that you just want to do on the side. You actually want to engage a lawyer to actually do this properly, and also have a security registration in place, which is called an ALPAP, and have that registered over the company. Now, there are many benefits, and the big one that we can answer the question different about, can I get my money out? So if you have the security, the loan agreement, and the security registration registered over the company, as we said, well, certainly the answer may well be yes. But as long as you have that registered within a 20 business day period as well too, which is important to highlight as well, because there is a time frame in which you've got to have that security registration in place. Now, the other aspect of that as well too is that it can also give a director power to appoint controllers or receivers as well, if we think it's really important as part of an insolvency strategy plan when dealing with a company as well.
So it's certainly a great tool, and we've spoken about it many times on here, and you talk about the specificness about when you need to put it on and when you don't, but there are options to secure loans that aren't in place before, and certainly it's worth looking at those for when you're looking at doing your annual reviews, which are, most of you would be well and truly in the swing of things at the moment. If there are loans there that aren't secured, then maybe it's worth looking at doing that now. So, but I guess again, as I've said 100 times before, the directors are acting like a bank. So let's give them the power of a bank to be able to look after things in their business. So, and again, it's happening a lot at the moment. We're seeing a lot of commercial brokers talking to us about people who are wanting to finance to put money back into the business, and talking about putting that security in place. So going back to what we normally see, which is unsecured directors' loans, is there anything else that we need to know?
Thanks, Ashley. Yeah, even though, the big thing is that without security, the money's probably lost. A liability loan, is something that we're quite happy to see when we're dealing with these companies. As I said, it can give us some level of voting power as well too. But as a loan is another credit, if you're looking at a VA or a DOCA scenario, the director's loan has the same rights as any other creditor and can vote in a DOCA if one is presented. And that's really handy as well too, especially if you've got other related parties there in a deed of company arrangement voting situation. But in fact, the director's voting rights as a creditor have all the same right, no matter what the vote is as well too. Now, I should note that it would be excluded in the new SBR under the Small Business Restructuring Regime, as the new legislation specifically excludes related party loans for voting purposes. So if you're looking at an SBR and you do have related party loans there in place, or related party creditors, please keep that in mind, that they will be excluded in an SBR scenario.
It's an important part of that pre-planning phase, is understanding where your votes are going to come from. So look, it's the reality is a liability asset loan is not as is not as problematic for a director, apart from the fact that they've already potentially lost that money. The other thing I should say is that we've talked about director loans and the Division 7A loan structure that sits there, but this can also apply like a liability loan for the unpaid present entitlement. So you see where money's flowing out of the trust for the tax return purposes, but the physical money doesn't go out, it becomes a liability that the trust owes. They can have the same impact there as the unpaid present entitlements, or the UPEs as they're called. So that's director loans. So let's move on and have a look at a few other issues that we can see when companies go insolvent without the proper checks and balances. Let's start with stock figures. That's another big one that we seem to have some issues with regularly.
Yeah, sure, certainly is, Ashley. And when we look at stock figures again, it's normally always an asset in the balance sheet.
And most of the time.
And, a liquidator is going to be looking at this and look at recovery through a sale or return scenario as well too, in terms of converting that stock into cash as well on behalf of creditors. Now, when there are moles out, especially, stock figures can always be inflated and create, major issue and trust issues, because it really can inflate the asset pool, reflecting the return in a dead company arrangement offer as well too. Now,
sorry, go on.
No, that's right. Yeah, and it can also have an impact exactly as well too, especially with PPSR, because some creditors will have a PMT in place and will be looking for return of the goods as well too in an insolvency situation as well, because they have that right over their goods that they provide on credit as part of their security arrangements to be able to get that stock back.
Yeah, and I think the big thing here is that, quite often, I've seen over the years that people guess at the stock figure at the end of the year for balance sheet purposes. Yeah, you're not doing full stock takes and all the rest of it. And again, all of those things will flow on quite fine in a world where you're not in insolvency. But once you hit a point in time where it hits, I know we had a case recently where the stock figures on the balance sheet were 1.2 million. And then when we actually got into the detail of it and getting some valuation work done for this client, the stock figure ended up being 200. So it completely changed the dynamic of what we could actually do for the client. And although we developed a strategy at 1.2, we then had to redevelop a new strategy when the stock figures come down. So again, making sure that the numbers there are real at the time that we're needing to put the freezing motion in place, that's what's really important here. So I guess stock figures are one thing. I guess any of the other assets that occur in the balance sheet would be a very similar thing if they're not the same as what the reality is.
Yeah, pretty much, Ashley. The one thing I'd say though is that a liquidator is not interested in depreciation value. They're looking at the sale price, which they can get much a higher, lower depending on the books, as you said there. But well, not even on the books as well too, especially if they run through the instant asset write-off as well. That we've seen some interesting accounting here for these assets that have been written off as well too under that scheme, which can become a problem, significantly down the track, and because of the fact that people have written it off, they really haven't taken the full benefit of it for those purposes, and becomes later an insolvency issue.
Yeah, well, the instant asset write-off, I think, is about to raise its real ugly head for a lot of businesses coming into this next tax year. I think for those who are advocates of the webinar and have been around for a long time, I mentioned very early on that I believe that you're actually going to create a real profit issue coming into this year and next year for clients who wrote off a whole lot to get their profits down. And now all of a sudden they've got no depreciation to offset some of that income. And we've already had, I've already had 2 phone calls from accountants going, we've done the numbers and we're going to have a real excessive profit because we used everything in the last year through the instant asset write-off. So it's now going to create, and the cash isn't in the business to cover the profit that they're now going to have to deal with. So it's something very careful to be. That's a future event. That's not so much a balance sheet item, or it becomes one, but the instant write-off. One of the other things we're seeing is that people are taking it off their asset register. So they're going, oh, I've only got 30 grand's worth of assets, but then you go and find out that they've actually got 100 grand's worth of assets because it's not showing on the balance sheet anymore. So I guess really we could go through a balance sheet line by line, and there would be a story that we could tell on just about every number that, just before I came online, I was looking at another client, had in her balance sheet, she had a cash balance supposedly of $90,000. But the bank statement and the bank account actually only has 20,000. So you create all these problems if you just go, I'm going to put my company into liquidation. You very quickly get to the point where the liquidator doesn't trust anything the director says. And that in itself can create a lot of issues when you're trying to actually work through managing through an affair when it's not represented. But we'll move on now, I guess, a little bit and jump ahead into to whether it's VA, liquidation, SBRs, getting that pre-look at a balance sheet and making sure that we know what's going on in there and what the truth of it is really important before you go into any insolvency scenario.
Exactly. You certainly hit the nail on the head there, Ashley. It's really important to have that second point of view of any client balance sheet in any of those situations, whether it be a VA, SBR or DOCA scenario, because that's where Jonge Reid really adds the value to, accounting practitioners and their clients, that we can give you that second opinion and really do a thorough review of the balance sheet and ask some of those other questions that might not be top of mind at that point of time, and then really uncover some of those hidden aspects that might be a problem down the track.
All right. So one of the other things that you wanted to talk about, and we put in the invite that we were going to talk about, was R&D audits. Yeah. Now, this is a little passion for you. So why don't I just hand over the floor to you?
Yeah. Yes, thanks for that. Yeah, it certainly is actually for a personal passion of mine from an intellectual property point of view, because one of the things that I'm seeing from time to time now that come across my desk is audits from the Australian Tax Office on R&D grants that have been supplied to companies. Now, a lot of this, I don't know if people are familiar on this webinar, for research and development grant incentive provided by the Australian government, managed by the ATO, but it's there to provide an incentive to companies for a financial incentive to invest in their innovation, whether it be software or other technologies to form part of their intellectual property. And they receive a number of benefits that they get through that grant as well too. Now, the problem that we have in this situation for clients that come to us is that there's a number of operators out there that do encourage businesses to take up the R&D grant, which is not a problem at all. It's not something adverse, but the thing is, though, is maintaining proper books and records and record keeping for the R&D process, because that's a real key component of this. And this is where a lot of our clients don't have these checks and measures, because when it comes to the ATO suddenly doing an audit, and if they find out that they haven't, the recipient of the grant, kept proper books and records around how they've developed the technology, how they've developed the hypothesis and things like that, and the end result of what they're trying to achieve through these R&D initiatives, the ATO is going to ask for that money back. Now, one of the clients that we dealt with recently had about a $500,000 audit that come across our desk, and was a real significant problem for him because of the fact that this $500,000 R&D incentive that he received, the ATO deemed that he hadn't kept proper books and records, and he had some significant intellectual property risk.
Right. And I don't think we're saying that we can help with the proper books and records, but I guess we're flagging that they're doing the audits now, and if you've got clients with it, just make sure that they are up to date. And if they're not, then you may have a bigger issue. So with this client, James, what was the solution that you came up with?
Yeah, so the solution that we come up with for our software developer client was to actually have a look at what his position of the company was, and as we've earlier touched on, looking at that balance sheet process. Now, one of the things that we looked at was possibly doing a VA and a deed of company arrangement. Unfortunately, that really wasn't going to cure the situation that the client was facing due to his cash flow and revenue position. So the process that we undertook there was to actually do a valuation of the goodwill and the related assets for the company and actually get their dollar value. We then sold those assets and goodwill across to a new trading entity and also an IP asset holding entity, which was also, a big part of the strategy for the client because it actually allowed him to have some asset protection around his IP, but opened it up for further IP licensing opportunities down the track. But also at the end of the day, it brought finality to this R&D audit that he had there and this tax debt, this debt that he was just not going to be able to repay under any other normal circumstances.
Right. Okay. Thanks for that. And so effectively, we looked at doing a restructure for him when he got caught up and doing that the proper way to get that through. So the other thing we are seeing a lot of is super audits. That does seem to be picking up and getting quite a bit of traction at the moment. And again, for everyone listening today, if someone gets flagged with a super audit, we're not saying that you walk away from the audit, but it may be that you do look at having a plan B as well and making sure that if things get bad and the numbers get huge, that you do have, like in James's R&D, when you start to deal with an audit, you might think you're going to get through, but making sure that you've got a plan B in place to work your way if it ends up being too big a figure for the business to survive. So I think that's, we're seeing, I think there's probably been about half a dozen R&D audits that we know of that have come through to us. And if we would only be seeing a very small portion of them in the way it normally works. And super audits are certainly starting to pick up as well. All right, so I think that's sort of, we've tried to just encapsulate a lot of the stuff around the balance sheet. I think one of the big things is that I wanted to be, before I give you, James, a chance to sort of wrap up for your stuff, is that when we're talking to clients, it's quite clear that most of them really don't look at a balance sheet at all. It's not a primary focus of theirs, although for all of us listening, we know it's the most important part of any business. So when they get into cash-strapped situations and you start thinking about insolvency, we really need everyone to be looking at the balance sheet, not the P&L and all that, and the P&L side of the business. Start looking at all those issues, both the personal asset and liability position of the director, as well as the corporate asset and liability position, because all of those things will have a really big impact. And please be aware that just letting it happen and going straight to an IP will open up doors that may well have the ability to be shut and closed off before you get there. So, James, I think that sort of pretty wraps up what we wanted to talk about today and the things that we wanted to cover. I will open up for questions I will open up the questions in a moment. So if you do have any, you can throw them in the chat group. But James, from a wrap-up point of view, did you want to have any final say before we close out and go to questions?
Yeah, certainly, Ashley. And thanks for touching again on those important issues of the balance sheet. But the other thing to keep in mind as well, too, for everyone out there, if you've got directors that are going to lend money or have lent money into the company, it's important that they do get a security registration in place. Even if it is past the time frame, there is still ways that we can rectify that. So a director can protect the money that they have invested and put into the business, and that they keep some kind of security position should an insolvency situation come down the track. And it's just a simple thing. You can just reach out to any of the offices, whether it be Brisbane, Melbourne or Sydney, or even up in the top in there in Mackay. Just touch base with us. If you any questions you want to ask in relation to that, we're more than happy to have a look at the situation and see if we can add value to your clients and protecting their security position.
Yeah, cool. Thanks, James. Joe, to answer your question, I have no clue. I think that there's, like always with the ATO, there could be a reallocation of staff and focus, and And I think pre the collection phase, they had a lot of collection people moving into other areas, and that flow-on effect is still occurring with some of the audits. But look, I think it's a good area from an Australian corporate citizen point of view. The focus on making sure that people are getting paid their super properly is really a good critical thing from a governance point of view. There's probably a little bit of governments putting pressure on it to make sure that they don't have to fund people whose super isn't paid later on. But that's just the cynic in me. I'll open up to any other questions that people have there. Obviously, we haven't talked about solutions to these problems, and the fact that if you do have these loan accounts, there are a number of different options that are available. But I'm really keen to have people pick up the phone and talk to me about the solutions rather than just going through it all now. But it is something that there are a number of things that we can do depending on what time frame we've got and all the rest of it. Joe, so do you think that there's more non-payment of super or late payment? I think you'll find that the non-payment of super is actually starting to increase when cash flow is getting tighter. So what we are seeing now is that, and it's been going on for a while, but what we are seeing is that directors of companies, because there's no a return of supply of goods. So if you need to pay this, you get something. Paying a super bill is something that they think they can get away with not paying this week, and they might pay it next week, and then next week becomes next month. So I think that there is a lot more of non-payment of super going on. And staff, as a general rule, we're Australian staff particularly, we're very good at being nice about it. So if your super's not being paid, then you go, oh, hey boss, I noticed my super hasn't come in. And they don't necessarily they're not willing to jump ship for all of it, because it's the day-to-day cash that they're actually looking for to pay their wages and pay their mortgages. So people will put up with non-payment of super a bit longer, as well as I think there is a huge amount of people who don't know how to look for their super, or don't look at their super to see if the payments are coming in every month. I just don't think we treat it as seriously as others would. Joe, you're keeping me busy talking today. Sorry. So do you think the ATO are data matching in the background and targeting the non-payers first? I'm not even going to pretend to know what the ATO does. I think, again, for those who were at the webinar in October, they did talk about the fact that Australia had one of the most sophisticated data matching systems. And they were spending an enormous amount of money updating that. And they were quite proud about that when they were talking about it in October last year. So there's a fair chance they're doing data matching, but some of the stuff I see, you wonder why they're focusing on who they are and what they're not. So look, that probably wraps it up for us all today. There's no other questions coming through. Jazz will put up our survey again shortly. So thank you, James, for joining us this month. I know that
Thank you.
I know a lot of you guys like to actually come on and or you're doing it under duress, but thank you for coming and joining us. I thank you all for joining us again this month and giving us 45 minutes of your time to listen to the latest updates that we've got. So on that note, if there are no other questions, we'll wrap things up from there. So thank you very much, and everybody have a great day.